Hello everyone, welcome back to our channel. We hope you've had a fantastic week. In our recent lessons, we've explored different balance sheet topics and how various items interact with each other. Today, we'll briefly summarize what we've learned, discuss why the balance sheet is so important, and touch on how it can be used for some basic financial analysis. Let's dive in. First, remember that a balance sheet is made up of two main parts, assets and liabilities, and they always balance. Assets are the resources we own or what others owe us. Liabilities are the amounts we owe to others, and equity represents our own funds used to finance the business. The balance sheet shows the financial position of our company at a specific point in time. Usually it's prepared as of the last day of a month, for example 31st of December or 31st of March. Depending on the requirements, companies might prepare their balance sheet monthly, quarterly, semi-annually, annually. It's just driven by the legal requirements or the management reporting requirements. Balance sheet helps to answer critical questions like: how much resources do you have available? How much do you need to cover your liabilities? Are your receivables higher than your payables? Or do you need to borrow money from the bank to meet your funding needs? Another key concept related to the balance sheet is liquidity. Liquidity means how quickly and easily you can turn your assets into cash. The faster and more you can convert, the more liquid your business is, and the better it can manage short-term obligations. In our previous lessons, we've always shown assets and liabilities stacked vertically, below each other, assets on top and the liabilities below, and we were always attempting to make those two parts equal. Sometimes you'll see the assets on the left side and liabilities on the right side. The logic is exactly the same, just the layout is different. The two parts still should be equal. Both layouts are perfectly fine. The choice just depends on personal or regional requirements or preferences. However, the vertical format is more common. When it comes to recording values, we've listed both assets and liabilities with positive numbers, relying on their names to tell them apart. But often, liabilities are shown with negative signs, like this. Or they can be enclosed in brackets like this. This method can actually make financial analysis easier, for example when calculating net working capital, which we briefly touched on in earlier lessons. Regardless of the format you choose, the core idea remains the same. Assets, liabilities and equity must always balance. And yes, we have learned the balance sheet always balances. This is connected to the concept of a so-called double entry. Every transaction you make on the balance sheet should have a mirroring transaction. For every addition, there is either an addition on another side of the balance sheet, assets against liabilities, or a deduction on the same side of the balance sheet, for example within the assets. It can be an increase or decrease in assets and simultaneous increase or decrease in liabilities. For example, repaying loans decreases the liabilities and also the cash in assets. Or it can be a shift from one item to another in the same class, in assets or liabilities. For example, decrease in inventory after selling apples and increase in cash you have received from this sale. Double entry is one of the most important, if not the most important, concepts in accounting. In addition, there are more items which can appear on the balance sheet. We will cover those items on the later stages as we progress with our lessons. But for example, those items can include fixed assets such as buildings, vehicles, software you own. All of these will be considered as non-current or long-term assets, which you use for an extended period of time. Same for the liabilities. You might have loans granted by banks for a few years, pension liabilities which need to be repaid only in a few years. Both do not require immediate funding. Also, you might have noticed that we've always recorded the items on the balance sheet in a specific order. Inventory on top, cash in the bottom, loans higher than trade payables. This is done on purpose and has a reason. The items on the balance sheet are typically recorded in order from less liquid to more liquid items, or from long-term to short-term. Long-term or non-current would normally be the items with the lifetime over 12 months. Short-term, below 12 months. For example, buildings last for decades. You can have investments in other businesses or some investment funds. Same for the liabilities. Bank financing, loans, can wait longer than your suppliers. That's why the loans are always above your payables. Getting value from cash is faster and easier than from inventory. Inventory you still have to sell and collect money from your customers. Cash you have here and now. That's why cash is normally at the bottom of the assets list. Often you will see the split of assets and liabilities on the balance sheet into non-current and current as subtotals, like this. So why is the balance sheet so important? The balance sheet is like a financial snapshot, showing exactly what a company owns and owes at a given moment. It tells us if a company has enough assets to cover its short-term debts, liquidity, and if it's strong enough to survive long-term, solvency. Balance sheet makes it easier to compare the strengths and stability of different businesses, especially when investing or lending. Warning signs like high debt levels or low cash reserves often show up clearly on the balance sheet before the problems become obvious. There are quite a few financial indicators which are calculated on the basis of the balance sheet, and they are used to assess financial health of the businesses. Some of these indicators can even be regulated and mandatory to be maintained at certain levels, for example for banks and insurance companies. Balance sheet is also a starting point for calculating net working capital and cash flow. Analysis of the balance sheet is one of the key inputs for the investment decisions. For example, when applying for a loan, a bank, among others, could check the following key performance indicators: current ratio, debt to equity ratio, debt to assets ratio, net working capital requirements, and cash conversion cycle. Cash conversion cycle is actually how much time your operations need to convert into cash. Great guys, time to wrap the things up. What are the key takeaways for the balance sheet topics? They would be: a balance sheet is always made of assets, liabilities and equity, and they must balance. Items are listed in a specific order from long-term to short-term, or less liquid to more liquid. Double entry accounting is crucial. Every transaction affects two accounts. The balance sheet provides essential information about a company's financial health and liquidity. Thank you so much for watching today's recap. If you found this video helpful, don't forget to like, subscribe and click the bell icon so you don't miss our upcoming lessons. See you in the next video where we will start with the income statement basics. And until then, keep learning and growing your financial skills. See you!